am the retirement plan consultant at TrustPoint. And before joining TrustPoint, I practiced law for about 21 years. I'm also a certified exit planning advisor. Broadly speaking, TrustPoint is a wealth management firm. We have expertise in all manner of financial planning, personal wealth management, employer-based plans, which is most prominently 401ks, and expertise in a variety of other wealth management and business advisory arenas. We are very proud to be a supporting member of the MVMA, and we work with a number of veterinarians and veterinary practices, as well as a wide variety of other businesses and individuals. And Allyson is here and will introduce herself a little bit too.
Yeah, thanks, Jon. Every time I hear Jon's kind of biography and background, I expect that he should already be retired with all those accomplishments. But I do like to joke that I was planning on going to law school and saved a lot of time and money and ending up in kind of a similar role as him. So I took the easy fast track. But with that said, you know, all of that legal background and just the different designations and passion for kind of 401k administration and finance in general makes Jon really, really great at the details. So he's an excellent resource for business owners. And then what I'm really passionate about is taking those details and kind of packaging it in a what's in it for you. You know, we know you're here today to probably get continuing education credits, but we want you to walk away with some action items, things that will ultimately benefit you, your practice, and your ability to hopefully retire when you want to, even if that means continuing to work because you enjoy it when you know that you don't have to do that. So that is our goal today, is to kind of pass along some information. And we're really passionate about this stuff because we know not everyone is. So we're here to help.
Exactly right. And we're going to try to cover a lot today. That means we're going to try not to get too in the weeds. But as Emma said, if you have questions, feel free to put them in the chat, or we're going to have our contact information at the end of the presentation and we'll disseminate the presentation to everyone afterwards. Feel free to email us. Feel free to give us a call. As Allyson said, we're into this stuff. So we're always happy to chat through an issue you're having or something that's come up and you just want to talk through with somebody. That's what we're trying to do, and that's what we're here for, and that's why we're a supporting member with the MVMA. So we're going to talk about financial planning broadly today, and to provide some information that will allow you to begin to identify, understand a variety of investment, financial planning issues as they come up in your lives and in your work. And as you see on the slide here, we're going to talk a little bit about budgeting and saving, retirement investing, education planning, etc. And then we're going to talk a little bit about, from time to time, we'll poke in with behavioral finance. That is, how does human behavior impact all of this and impact financial planning? That's interesting, and it can be helpful to keep an eye out for it to see if you're having any of those sort of behavioral issues that you can correct and help yourself plan better for your finances. So what is financial planning? I think this is a great quote on the screen. It comes from the FPA of Minnesota, the Financial Planning Association, the Minnesota chapter. I think it just really sets it out nicely. Another way to say this is financial planning is basically looking at where you are financially and making a plan to get where you want to be. As you can see by the diagram, it's a lot more holistic and broader than just how to use your 401k or investing or estate planning. It's really bringing all those aspects together and tying them together into a plan that you can act on. And having that plan from a behavioral standpoint can be very helpful in helping you to fight your own instincts. Because generally speaking, we are simply not wired to proceed rationally in connection with money. So having a plan and working that plan can really make a big difference.
So budgeting is a part of the financial planning process. And I think a lot of individuals that I've worked with over the years kind of react to the word budgeting similarly to the way that they react to the word dieting. It kind of makes you think of restriction and something that's not particularly fun and requires a lot of discipline. And that can be the case. But I think we really overcomplicate the process. So it can be really simple. It's a matter of trying to control your money instead of allowing your money to control you. And it often starts with just tracking your expenses. So there's no attempt to change what you're doing necessarily. But the biggest thing that I see is that individuals that we work with have never really tracked their expenses or categorized them. So it's not always about changing your spending habits. Sometimes it's just about knowing where you are spending money. And then a good rule of thumb, once you've done your tracking and kind of categorized your expenses among these needs, wants, and savings categories, is it's a simple rule. It's the 50-30-20 rule. So we would encourage you to spend no more than 50% of your budget on things like housing, food, health insurance, medical expenses, transportation, and debt payments. No more than 30% of your budget on clothing, restaurants and bars, travels, and entertainment expenses, and then 20% of your budget on savings. Typically in the retirement plan services industry, we'll talk about 10 to 15% being the ideal range for going into a 401k, an IRA, or some sort of retirement savings vehicle, with that additional going into an emergency fund or to pay additional debt down. But I always like to point out that we are telling you you can spend more on your wants than we are on your savings. So I like to point that out, that again, it's not intended to be restrictive. Of course, some people's budgets are naturally going to be more restrictive and the cost of everything continues to rise. But the idea is really to make sure that you know where your money is going and that you are the one that's in control of that, instead of just kind of letting things fall where they may and not recognizing where you're spending money. The biggest area of expense in most people's budget fall under the needs category. So housing, transportation, food, insurance, contributing to retirement. So those also are the biggest areas where you can find cost savings. As people get closer to retirement, sometimes they downsize their home or they drive a used car. There's a lot of, because those are such a huge chunk of everyone's budget, there's a lot of things that you can do to kind of tweak your plan going forward as you're looking for ways to save money. So that is things that can have a big impact. But on the next slide, you'll see that even small things can actually have a big impact over time. So I will definitely tell you, I've worked in the retirement plan industry for 14 years now. And I have seen people pass away a week before that they were scheduled to retire, or a couple months into retirement. And that's always sad. So I definitely advocate for a balanced approach and living while you're alive. But we all know that there are things that we spend money on that it's not necessarily enhancing our quality of life or standard of living. Sometimes it's a convenience thing. Sometimes it's just we're not thinking about it. So a good example, I don't know many people that get coffee every single day, but we all spend probably $5 on something a day. So if you instead saved that over 30 years instead of spending, you could be looking at almost 90,000 in additional savings just from making little tweaks on a daily basis. I know for me, I'm definitely guilty of having shows that I like on different streaming services and then signing up for 1 month to binge watch the latest episodes of a new show and then forgetting to cancel that subscription. So there's been quite a few months that I've paid for more subscriptions than I've actually used. So it's all those little sorts of things that if you actually do go through the process of tracking your expenses, again, not to restrict, but just to recognize where your money's going, you're likely to catch those things instead of missing them for a month or two. And then you can add additional savings into your retirement accounts or savings accounts. So it can have a big impact over time. If you get lunch and coffee every day and you save that instead, you could be looking at an additional $250,000 in savings, especially with the cost of lunch and coffee these days, probably higher now.
Next, we're going to shift gears a little bit and talk about retirement investing. And as this slide suggests, the first thing to consider are the sorts of accounts available to aid in retirement investing. And on this slide, as you can see, there's a wide variety of options for retirement savings. First, a standard taxable brokerage account. Next, what we would call employer-based accounts. Most prominently, a 401k account. Almost everybody has heard of a 401k. And a 403b and a 457b are similar, except generally speaking, a 403b is available for not-for-profit organizations and some government employees, and a 457 is for state and local government employees. Simple and SEP IRAs are similarly employer-based, but they have some different rules and different ways they're accessed and used. Third on the list, personal retirement accounts, generally IRAs. These are personal accounts you would set up outside of work, denoted specifically for retirement, and they have some specific features designed to affect retirement savings. And finally on the list, we put specialty accounts, and HSA, a health savings account, being the most important example of that. This is a bit of an alphabet soup, a bunch of accounts. So how do you think of these accounts and how to use them to help you save? That's what our next slide is about. The concept here is to give you some ideas about how you might prioritize, how you might use the different sorts of accounts to save for retirement. And remember, as a first point, for this discussion, we're focused on retirement savings with this slide and this priority list. Of course, if you're looking at other financial goals, a down payment on a house, college savings, etc., you're going to use potentially some different accounts, some different techniques to get there. But in the retirement savings realm, we generally consider the 401k or any employer-based retirement plan, if you have a 403b or 457, same idea, to be the first place you should be saving for retirement. And the reasons are listed up here. There's a tax advantage. You can either have a traditional account or a Roth account where you defer tax or pay tax now but save on tax later. You get high limits in your 401k account. In 2024, for example, you can defer up to $23,000 of your salary into a 401k account if you're under 50. And if you're over, you can defer an additional $7,500 as what they call a catch-up contribution. Plus, your employer can add more. Your employer can put a match or some profit sharing into a 401k. So you can really put meaningful amounts of money into these accounts in a tax advantage way. Maybe the most important part of these sorts of accounts is they are automated and simple. In other words, you don't have to make the deposit every time you get paid. You don't have to think, hey, I need to make my retirement savings contribution. You do it once, you set it up, and then it happens automatically every time you get paid, generally speaking. And that's a real positive and really ties into that behavioral finance component, because if you had to do that every time on your own when you got paid, the likelihood of success would be much lower. And that's one of the real reasons these accounts are helpful, meaningful, and first on our priority list for retirement savings. The fourth reason is protected. These offer some meaningful protection from creditors, both in and outside of bankruptcy. Going down the list, the next item we have, the next account we would suggest you consider using is a personal IRA. Again, there is a tax advantage with a personal IRA. These are accounts that are set up to help save for retirement. So there's a tax advantage. The government is incentivizing you to save for your retirement. They have good limits. In 2024, you can put up to $7,000 into one of these accounts. And if you have a spouse, your spouse can set up their own account and put another $7,000 in. And if you're 50 or over, you can add a $1,000 catch-up contribution on top of that. And they also have some protection from creditors. It's more limited than the 401k, but sometimes that protection is important. And one other thing I'll add, and this applies both to the 401k and the IRA, is these accounts are also protected from you. They strongly disincentivize and actually make a little bit difficult removing money for anything but retirement. There are ways to do it if you have to. There are hardship distributions. There are other ways to get at the money if you really needed it. But since they're designed so that this money is there when you retire, they make that a little bit difficult and put some hurdles in place to do that. And in fact, there can be some meaningful penalties if you do that. So they're really designed to hold the money and keep it from you and make you say, hey, do I really need this money now, or should I do the smart thing and let it ride until retirement? Next on the ladder of priorities here are specialty accounts, and HSAs are what we are highlighting. Not everybody is going to have access to these accounts. They are very specialized. They are only available if you have a high deductible health plan. If you don't have a high deductible health plan, you're not going to have access to this. But if you do, they are a helpful vehicle and you should really consider using them. They have pretty good contribution limits. In 2024, you can contribute $4,150 for an individual and $8,300 for family coverage. Most people contribute to an HSA pre-tax through payroll deductions at work. And unlike sort of their cousin, the flexible spending account, called an FSA, the money in your HSA can remain in the account from year to year. You can earn interest, you can invest the money, you can even take your HSA with you should you switch employers, and you keep it when you retire. It's portable. And if you're no longer covered by a qualifying plan, let's say you leave one employer who has a high deductible plan, go to one that doesn't, you can't contribute anymore to the HSA, but you still hold the account. It's still your account, and your previous contributions can continue to grow in a tax-advantaged way. And these accounts are really something, because it even gets a little bit better than that. Assuming you use the HSA funds to pay for qualified medical expenses, you don't pay any taxes on the funds. The funds can come out tax-free and be used to pay tax-free, and you don't pay taxes on them. And that's an unusual deal from the government. And further, once you hit 65, you can use the HSA to pay for any non-qualified medical expense. So really anything. Let's say you want to buy a boat in retirement, you can use the money to do that. You're not going to get the full advantage. That's not going to be a tax-free transaction. You're going to pay taxes when you take the money out, but essentially you're going to have converted the HSA at age 65 into another traditional IRA. And it's another great form of savings, another tax-advantaged way to save. And then finally on the list, we have a taxable brokerage account. And I'm sure most of you have heard of this. It's a standard brokerage account. There's no tax advantage, but the advantages are there are no limits. It's extremely flexible. You can invest in almost anything you can think of. And it also gives you what we would call tax diversity. Because there's no immediate tax advantage and you pay your taxes as you go, that might be helpful when you retire, so you can decide what bucket of your savings to take money out from.
That's on mute. So there is a relationship between risk and return when you're looking at investments. Most people are already familiar with that, but they're not necessarily familiar with the different levels and why there's different levels of risk. So the first being cash equivalents right at the bottom, low risk, but low expected rate of return. And of course, you're always subject to the risk of inflation. So as the cost of everything that we're purchasing, we've seen that lately, continues to rise, if you keep your money under your mattress or in a cash equivalent, there's a very high chance that you won't outpace that inflation. So the purchasing power of your dollars goes down over time. Then we have bonds, a little bit above that, and international bonds, and then stocks and international stocks, with risk increasing, but potential expected return or potential reward increasing as well. Really, if you think about bonds and stocks and the difference between the two and why there's a difference in risk, If John and I owned a company, maybe we make some really cool cat grooming brush and we make it in this very boring gray color and you can't put your logo on it. Everyone loves it, but it's a little bit plain. And so we get this feedback that we should change our machinery so that we can put logos on it and make it in lots of different colors. That's a silly example, but that's all that's coming to my head right now. So John and I are owners. We own this company, but we actually are going to issue corporate bonds. So we're going to allow people to loan us money as a corporation for this project to be able to upgrade our equipment. So of course we issue corporate bonds, we upgrade our machinery, and these amazing brushes just go wild. Everyone wants their logo on it, and we make a lot of money. So who's going to get paid first? Are we going to have to pay those lenders back, basically repay our bonds, or do John and I as owners get paid first? Well, the answer is, of course, the lenders get paid first. So it's very similar to your own personal budget. You're hopefully paying your expenses, your creditors first, and then paying yourself. And so that's how it works with stocks and bonds too. So that's why, there's less of a risk. Even if a company went bankrupt, if John and I did a really poor job with everything and we had some cash, the lenders would still get paid before we would. So that's kind of the difference at a very high simplified level between stocks and bonds, and why there's less risk in bond ownership. So a well-diversified portfolio is going to have kind of many different components, some bonds, some stocks, depending on where you're at in retirement. John, if you can go back, actually, I like to think of this as a staircase of risk. So it kind of looks like a staircase. My son fell down our kitchen wood stairs into the basement on the concrete floor when he was 18 months old. And I was freaked out, first time parent. And he was totally fine. He bounced up at the bottom as if nothing had happened, was running around. So I liken that to a 21-year-old investor who's just started. They have $1,000 in their account. Markets tank by 35%, a really big market downturn, and they've lost $350. That hurts at that age, but they're not having to live off of that account, even though it's the same percentage loss. Totally different than a retiree who's got $1 million who's lost $350,000 in the same time period because of the same percentage return. So the idea is you want to kind of take some steps down the risk staircase as you get closer to retirement. That's not true of absolutely everyone. You may have circumstances that allow you to continue to maintain high risk throughout your career. But on the next slide, you will see, and in my experience, I work with thousands and thousands of plan participants, so individual account holders within 401k plans. At about 10 years until retirement, many near retirees will start investing as if they are going to spend their entire retirement account the day that they retire. That's not the case, and they rationally know that that's not the case, but that's kind of what their behavior dictates. They get extremely conservative with their investments, move to all bonds or cash. It is a very stressful time in your investment trajectory. So I like to show this chart because you can see that regardless of what your actual age is at the point of retirement, we would recommend still having up to 60% stocks in your account. The reason being that the goal of your retirement account is not your retirement at all. It's your lifetime. So our financial planners, they use the politically correct term end of plan. This account is supposed to last through your lifetime until the point of your death and maintain your standard of living during that period. So if you invest in bonds or cash too quickly and don't allow your stock exposure to continue to grow even after you've retired, you do run the risk of running out of money too quickly, which is not the goal at all, obviously. Education planning is huge. So I always like to, you hear this example for a lot of things, but when you get on a plane and they do the safety information, they talk about putting your own oxygen mask on first before you put it on anyone around you or help your kids. And we believe that the same is true for retirement planning. So make sure that you're saving for yourself first. And also saving for your children. It's up to you to decide what's going to be important to you in terms of if you're saving for you or your kids, but just make sure that you do have that component in place so that you have something for when you get to retirement. But obviously, we all know the cost of education is rising and rising quickly. Looking at the public 4-year, that's the second category down. I know both John and I have kids that might be going to college at some point, and it's really scary. Mine's at about the kind of 12 years from now range. So I'm looking at a cost in 2020, 2021 of $26,000 annually. That does include room and board, tuition, fees, and expenses. So it is kind of an all-encompassing cost. But even 12 years from then, which is, a little bit less than 9 years from now, 45,400. So that's a terrifying number, and that's an annual expense. So we did want to cover, that we get a lot of questions on, okay, I'm saving for retirement. I have a little bit of money left over. What do I do with it? How can I help my kids out? So on this next slide, there are some tax advantage plans for being able to, help your kids or grandchildren or other family members with college expenses. You're probably familiar with 529 plans. These are kind of state run. They allow tax-free investing and distributions for qualified education expenses. So qualified is determined by the IRS. Any non-qualified withdrawals, so if a child was to take money out for reasons other than qualified college expenses, there is a 10% early withdrawal penalty, or just withdrawal penalty in general. And then the amounts that come out are taxed at ordinary income tax levels. Traditionally, these, in each state has different rules with regards to if it's a state tax deduction. Specifically in Minnesota, you can contribute to a 529 plan and get a tax deduction within certain kind of requirements. But in the past, one drawback of these accounts was that if it wasn't used for expense or education expenses, you set it up for someone and they decided not to go to college, then all of that would be taxable and penalized. Now in 2024, there is an option with some limitations to roll over a 529 plan balance into a Roth IRA for the same beneficiary. So that's new as of 2024, and that does make them slightly more attractive than they used to be for both the current tax savings and then ability to kind of convert it to a Roth. There is another type of account that we often see used in education funding. It's a custodial account, often known as an UTMA. The funds must be used for the child's benefit, but they don't have to be used for college expenses. So at the age of majority, very often 18 is what we see most frequently, the child will have full access to those funds to use them for any reason. But you can continue to fund, and there's a lot of different investment options. Typically, these are found at banks. So those are two that we see most often. We do tend to see some individuals fund their own Roth IRAs for college expenses too. So that's not on the slide, but that's an honorable mention. You can take out money from your Roth IRA for college expenses, and that is not subject to a penalty. So that can be a nice option. As well, if you're more interested in starting to save for your retirement, but want to have the flexibility with one of those accounts as well. Oop, John, you're on mute. We both did the same thing.
Yeah, apologies. Before we move on, I'll just say my daughter just started high school. So these college planning issues are front and center for us at home. It's something that we're really thinking about. And some of this planning can really be helpful. And it makes a big difference as you approach that that expense and that exciting time for your kids. Okay, next we're going to talk a little bit about estate planning. And you can see listed here a number of the objectives of an estate plan. Avoid intestacy, provide for your spouse and children, provide creditor protection, distribute assets, etc. But I think the big idea here and the big takeaway is that doing estate planning, having an estate plan, allows you to control what happens. Because if you don't have an estate plan, there may be some significant unintended consequences. The state is going to be in control, not you, the courts, most prominently. Medical decisions might be made by the wrong people. A judge could end up choosing a guardian. So you can see that there are a lot of things that could be out of your control in a way that most people wouldn't want. Most people would prefer to have some kind of plan so that they can make these decisions ahead of time and have things ready for when they pass or become incapacitated. And I'll touch on the first one very, very briefly, avoid intestacy. That's kind of legalese. Intestacy really just means when someone dies without a will, without an estate plan. And what it means is the court will take full control, and there are intestate laws, someone dies intestate, that the court will then follow to distribute your assets, to care for any minor children, and things like that. So it's really the extreme example of no control versus having an estate plan, doing some planning, and taking control of these issues. And how do you take control? Generally speaking, we would recommend, whether you think you have a sophisticated estate or not, whether you think you have a lot of money or not, that everyone should really consult with an estate planning lawyer, because there are a number of documents, there are a number of strategies that may work for you, that may make a difference, that they can work through with you, and it can really have an impact on how things go. And as you can see here, there's a whole host of documentation and methods for estate planning. We'll talk about a couple of these methods. First, the will. This is sort of the traditional way to pass assets and property through probate. Importantly, it doesn't avoid probate, so it doesn't avoid that court process, but it's basically your written directions to the court, telling the court, hey, this is how I want my estate handled. There are some requirements under Minnesota law as to how a will be valid. They're pretty straightforward, but again, that's why we generally recommend folks, meet with an estate planning lawyer. And the will can effectuate basic functions, right? It can name a guardian for minor children, appoint a personal representative or an executor, provide for payment of debts, and dispose of your property, distribute your assets in the way you want done. The second one I'll talk about is a revocable living trust. This is another legal document that essentially lets you direct how your assets are distributed after you die. It's giving you control versus the court and the state having control. It's a little bit different than a will. A living trust actually owns the assets you transfer to it, while still allowing you to use and control that property during your lifetime. This type of trust can be changed, terminated, revoked after it's set up. And the big three reasons that some people do it is it avoids probate. Unlike a will, it avoids the court process. Because of that, it provides a little bit more privacy, right? You're not going through that public court process, so there's more privacy. Also, potentially faster settlement of the estate because you don't have as much time in that court process. One quick thing to note is if you do have a living trust, you likely should also have something called a pour-over will. It's a type of will that works in partnership with a living trust. It's essentially acts as a sweeping function, a catch for property you didn't put in your trust during your lifetime. And it's that direction to the court that says, hey, court, what I want you to do with this property that isn't in trust is put it in the trust. And then the trust will figure out where it goes, court. You don't have to use your power to do that. I'm telling you what to do with it. And then the last one, and there are some other issues with that make it a little bit helpful in terms of avoiding probate. But I also want to hit on beneficiary designations, and PODs and TODs are part of that. And beneficiary designations are available. You'll probably hear about them in connection with your 401k, but they're also available for almost any account that you have. Even your bank accounts will allow for designations most of the time. And they are very effective and inexpensive estate planning. They're also very powerful estate planning, so you have to pay attention to them. Beneficiary designations will actually trump a will. So if your will says one thing and your beneficiary designations say another, the beneficiary designations are going to take precedence. So there's something that you can affect very easily. There's something that's very effective at passing your assets, and there's something you kind of got to stay on top of. Usually we say to people that they should take a look at them when a major life event occurs, when you get married, when you get divorced, when you have a kid, when you adopt a kid. Take a look at them and maybe take a look at them once a year to make sure they're up to date, because they can be very helpful in your estate plan, and they are a very, very powerful method. They're straightforward, and generally there's no cost to set them up. This slide I'm not going to talk about too much. It's generally an overview of what gets probated. In other words, go through that court process versus stuff that doesn't get probated through the will. This is going to be included in the PowerPoint when we send it. I think we'll send it to Emma and Nicole, and they'll distribute it to everyone who's attending today. And you can use it kind of as a reference point. It lists a number of accounts that bypass probate and talks a little bit about what does get probated. So it can be helpful as a reference point as you dig in on an estate plan and talk about that with somebody. Next, we're going to move on and talk about succession planning. And succession and exit planning, generally speaking, are for practice owners or anyone who might someday be a practice owner. And it's an important item to consider probably sooner than you might think, because when you think about it, your ownership in your veterinary practice is almost certainly one of your most valuable assets. And succession and exit planning, first, it's really just good business strategy. But what you're doing in succession and exit planning is really preparing your business to get the most value for you when you do decide to transition or sell, as we say, exit the business. And like I say, doing that really is just doing the kind of things that make the business run smoothly, make it profitable, and ultimately make it transferable from you to a new owner. And done right, it takes some time. We generally will tell people, if you can, you want to be doing this kind of planning about 3 to 5 years out from when you'd like to exit or transition the business. It's not short, it's not a simple process, but if done correctly, it can really have an impact on what that exit looks like, what it feels like, how prepared you are for it. Now, of course, all the time it comes up that we have a shorter time frame, and that can be dealt with and handled. But as the time gets shorter, you just lose some of the options and some of the ability to adjust things and make a plan that can really work and provide for the best possible result. Now, this slide sets forth the overall concept of succession and exit planning. And I kept it very high level because there are similarities, certainly within the veterinary industry, and no two practices are the same, but some veterinary practices have similarities, but ultimately no two practices are the same, and no two practices have the same exit plan. But you can apply this same concept, the same overall methodology to achieve good results. And when you look at sort of the arrow that we've got set up on the screen there, you can see that the first step is always to assess. And that's simple but not easy, right? You want to just have a good sense of where the practice currently stands before you really get rolling with the process. And this can really be an in-depth investigation. It can sometimes be a very lengthy process. It will undoubtedly involve a lot of questions, document review. It may involve engaging accountants or other valuation experts to see where your practice stands financially. It may involve engaging lawyers, HR experts to do legal and process audits in those arenas. In other words, you really want to be looking at every issue in the business and having a good sense of where it stands. It may involve chatting with employees, getting a sense of the practice culture. Whatever it includes, this kind of assessment is critical because it really sets the stage for where you're going to go and what needs to be done to get the business ready for sale or transition to incoming partners or something like that. And after you've done that assessment, the next step is setting targets. And this is pretty straightforward, right? We've assessed. Now, where do we want to be at the end of the process? What is the goal? And that often takes the form of trying to achieve or trying to head toward a certain valuation for sale. But it can often, in the veterinary arena, also take the form of we want to bring on 3 new partners and allow 3 of our partners to retire. Or it can just take the form of we want to update and adjust our HR and legal practices so that they're better, so that if we do exit, if we do sell, someone looks at what we're doing and says, hey, this is ready to go if I take it on. If I buy this business, I'm not going to have HR and legal issues. So the targets can be different from practice to practice, but setting those targets is critical so you know where you're ultimately taking the process. The third, you see here, assemble and plan. This is twofold, right? One, assemble. That we're using that word to mean who do you need on the team? What kind of people do you need on the team to get from where you are in the assess to the targets you've set? Who is necessary? Generally, you're going to need a financial advisor. You're going to need an accountant. You're going to need a lawyer. You may need HR experts. And where we really come into the process, just to speak briefly from the trust point end, is on that financial advisor aspect. That's really where we get our hands dirty and tie in. And what we can do at Trust Point is pull in all those other people. You know, we know lawyers, we know accountants who can fit the bill. We can introduce you to them. You can see, hey, does this person fit with me or not? And you can start to assemble that team to start to put your plan into motion. And the plan, once you have the team, you set up and you say, okay, these are the specific items we're going to do to achieve the targets. And from there, you go into the next step, which is implement and repeat. There, you're taking those specific action items and saying, hey, we're going to keep working to achieve these items to get where we want to be. And as a CEPA, that's a Certified Exit Planning Advisor, we would generally recommend breaking this into what we call 90-day sprints. In other words, you decide on an actionable item that can be achieved in 90 days. And then you go those 90 days and you say, hey, did we achieve it? If you did, great. You move on to the next step. If you didn't, you revisit, you adjust, recalibrate, and you repeat. And you do that over and over and over again until you achieve the goal. And I think given the description I'm giving you, you can see why we like to see people with 3 to 5 years of time, because if you really want to do this process, that's kind of what it takes. And finally, after you've done all that and you've achieved the targets you want to achieve, you exit and transition. And then you either make the sale, you bring on the partners, whatever that exit looks like. And hopefully the process is such that that exit, that transition is as valuable, is as lucrative, is as smooth, is as helpful for you, and not just you, but also your employees, your team. Most folks want to protect their team, want to be good to their team, and that's an important part of the process too. I think that's all we've got. The next one is kind of our final thoughts. Because we value the 401k so much, we always say take a hard look at the 401k. If you've got a good plan, great. If you're not sure, talk to us. We can give you a second opinion. We analyze 401ks all the time. Budget, save, invest, and plan. And consider hiring a personal financial advisor. But we're happy to talk you through what that should look like, what you should be looking like in an advisor, what you should be looking for in an advisor, because we really think a fee-based fiduciary is the way to go. Excuse me, and we can talk you through what that means.
Thank you so much for that presentation. I would like to remind folks that if you have any questions, please put them in the Q&A box. In the meantime, I do have a couple questions. One of them being, what are the limitations on the Roth IRA 529 rollover option?
I can get into that. There are IRA contribution limits each year. Those do kind of index. Usually the IRS will announce in late October what those contribution limits are. But if you're rolling a 529 balance over into a Roth IRA for the same beneficiary, and that's one of the limitations to it, does have to be for the same beneficiary, you can't exceed those limits for the year. So many people have to kind of roll over in stages. In addition, the 529 plan has to have been in place for at least 15 years. So there may have to be a holding period if it was set up closer to the age that someone was actually potentially thinking of going to college or would have used those expenses. If it was set up later in life, there's a 15-year holding period. There's a maximum lifetime rollover amount of $35,000 as well. So those are the limitations. Still a good option, better than having to take the money out and pay penalties on it. But of course, limitations apply.
Thank you.
John, it looks like John's trying to say something, but he's on mute.
Sorry, I muted him.
I think, I was wondering, I thought I didn't do that. I was just going to say that Roth rollout option is really helpful because it allows people to save in the 529 and be less concerned with over saving in the 529, which of course is a bit of a limited account in what you can do with the funds once they're in there.
Perfect. The second question I have, John, I'm going to mute you again. I think there's some feedback. The second question I have, I think, would pertain to both of you. And it is, what are some of the biggest mistakes you tend to see over and over when working with clients on these kinds of topics? Are there any things that people should really be thinking about or considering?
I'll take it first. Waiting in general, waiting to talk to an advisor, waiting to save in any sort of retirement savings account, waiting to have an estate planning discussion because it's an uncomfortable topic for many people. The sooner that you do any of those things, the better off you're going to be across the board. So I think I always encourage people to just take an action, even if it's a small one, even if you start with just, you haven't been contributing to your retirement savings account, do that now, and then work on the next step. So kind of do the next right thing, but definitely waiting. I just can't tell you how many kind of horrendous beneficiary situations, beneficiary payout, awkward situations we've run into because people didn't have their estate planning done correctly. And, or just, people who can't retire and have very, very limited savings in their late 60s. And that's really tough to be in our role and working with those individuals and wishing that we could have gotten in front of them sooner.
I would just echo that first. That's exactly what I would have said, that the sooner you can attend to these issues, the better. But I'll add to that, and I think it ties in with why people wait. They overcomplicate it. They overthink it. They say, hey, I know we're listing out priorities and accounts, but it's better to get started anywhere. Period. End of sentence. It's better to talk to somebody and get started anywhere. And if you start putting money away, and then you can adjust as you go forward, right? You can add in an estate plan. You don't have to have everything perfect from the start. Just get started. And I think that's really the biggest problem we do see, is that folks put it off. And we show our clients projections about different starting points with, let's say, a retirement investing plan. And the difference is stark and meaningful. Putting that kind of investing off 1, 2, 3, 4, 5 years has a meaningful impact on what retirement is going to look like.